My name is Dumisan Chirisa. I'm a qualified chartered management accountant and I'm a CIMA member. I'm also a senior accountant at Trade Financial Services and an instructor at Ilumeo. I will be taking you through this course where we're going to look at introduction to the auditing profession, regulations in the auditing profession, assurance engagements, internal controls, and the auditing process. Our course will be structured as follows. We're going to have topic 1 to 5, in which we'll cover introduction to auditing, regulation of the auditor, assurance engagements, the auditing process, engagements to review historical financial statements, in that order. Let's move on to start with our topic 1. So in topic 1, as we said, is going to be introduction to auditing. In this, we'll be talking about the auditor, describing who is an auditor, and discussing what auditors do, assurance and non-assurance engagements. We'll talk about auditing postulates, the accounting profession, and financial statement auditing engagements. Let's get into this in detail. So what is an auditor? Who is the auditor and what do they do? So auditors in general are there to give an opinion or a conclusion on the financial statements of a company. They are there to state whether company's financial statements were presented fairly and in accordance to the international financial reporting standards. So they will be reporting to the shareholders, obviously, who are ultimately the appointers, through to the board. So we have got different types of auditors, which we will talk about shortly. But auditors of all types provide assurance pertaining to information prepared or presented by one party to another party with the intention of inspiring confidence in the fairness of the information which is being presented or prepared. Now, why is there a need for auditors? So in short, we've got 3 reasons why there is a need for auditors. First of all, to have a split between ownership and management. So they come as an in-between candidate or in-between person to give assurance, obviously, to the owners that the management is, in all material respect, presenting fairly the financial statements and the activities that are happening within the company. Secondly, they are there to give confidence in the financial information, which means all the financial statement that has been presented, and for accountability. Now, we have got different types of auditors, starting with the external auditors, which is the focus of this module. So in this module, when you talk about auditors, we are referring to external auditors. These ones are there, usually working in an audit firm in which they go to give assurance on different client information on client financial statements. So they mostly work for audit firms like your KPMG, Ernst & Young, and so forth. We've got internal auditors, usually forming part of an internal auditing department of a company. Most bigger companies, we have an internal audit department, which will be headed by a chief internal auditor, who will do all auditing stuff for the company. They also work hand in hand with external auditors during auditing and in putting in place internal controls. We've got government auditors, usually work in government branches and also state-owned entities. We've got forensic auditors. These ones are responsible for investigative kind of auditing. We've got special purpose auditors, who are usually appointed for a specific issue that they need to audit and give an opinion on. So these are the types of auditors that we have. But as I said, we will be looking at external auditors. So auditors in general are there to perform an attestation function, which means validating that something is true. or stating that this is not true, and we can take these corrective actions to make it true or fair. They provide an independent opinion on the financial information that they examine. They work usually for independent audit firms, like I said, the Ernst & Young, KPMGs, and so forth, Grant Thornton. They are usually not an employee of the companies that they audit. They report to the shareholders, which categorically are the appointers, as they're supposed to be independent of the company, its board, and they report obviously on behalf of shareholders. Now, they function independently from the company, as I explained, and obtain a mandate through legislation. So in various countries, you have a legislation that gives auditors a mandate. Or for example, in South Africa, where we are based, we have the Audit Profession Act, which gives auditors the mandate to perform their duties. Of course, in hand in hand with the regulatory bodies that are here, as well as the corporate code of ethics that are here. So yes, in your countries we have such Auditing Profession Act, which governs them and gives them the mandate to do this. This was mostly because of various scandals that have happened over the years that have caused losses on behalf of auditors or on behalf of shareholders, and there was a need for auditors. Now, there are some fundamental ethical principles that auditors have to abide by in carrying out their duties. And of course, they have to be independent. They have to practice independence and make sure that they are independent of the client firms that they audit. Independence is common to all assurance engagements, but is not the only essential characteristic. The International Federation of Accountants lays down fundamental ethical principles that all auditors are required to observe. For example, here in South Africa, our local bodies, accounting bodies like the South African Institute of Chartered Accountants, has also adopted the International Federation of Accounting code in its entirety. This will be true for your local bodies in your local country, in your countries. For example, if it's in England, you have bodies like ACA, CIMA, the Institute of Accountants of England and Wales. We have all their codes also conforming to the International Federation of Accountants Code of Ethics. So it is generally the same elsewhere. Now, the fundamental ethical principles are 5, and include integrity, which means being straightforward and honest in all professional and business relationships. It means an auditor or a practitioner, which is an auditor in this case, will have to carry himself in an honest way, in a straightforward way, and will be able to state the facts to the shareholders of what's happening within the company. They also have to be objective. They have to practice objectivity. That means not allowing bias or conflict of interest or undue influence. So if they find that there are grounds of conflict here or conflict of interest, let's say having shares in a company that they're auditing, they have to excuse themselves from such an auditor, such an audit, because there will be grounds for bias. So they have to be sure that the client that they're doing business with do not have any familiarity or kind of self-review that will happen in them carrying their duties. Also, you have to have professional competence and due care. That means they have to maintain a certain level of knowledge that is required to carry out their duties and to perform their work diligently. So as part of this, as part of this professional competence, that's why we also have this course, which is required of people in this field or the financial field to know and upskill their knowledge in terms of professional competence. That's the same that will be required for an auditor. And then we have got confidentiality. That means keeping client information and documentation confidential. It means they have to be sort of secrecy that needs to be abide by, unless it is required by a court case or maybe acts of court, and of course in agreement with the client, then such information may be disclosed. Then professional behavior, that means complying with the laws and regulations and avoid action which discredit the profession. Professional behavior is quite important, especially looking at the many company scandals that have happened, like Iran, like Steinhoff, that have happened over the world, throughout the world. And this is very important because in most of those scandals, auditors have been in front or part of these findings. So this is important. We will talk about this also at a later stage and we'll expand on them. Now, in general, auditors are there to provide assurance on financial statements. So the types of engagements that auditors are involved in can be categorized into two terms, which are assurance engagements and non-assurance engagements. These are the type of work or engagements that auditors are involved in. Now, let's look at what is an assurance engagement. So an auditor is expected to give the client a degree of assurance that the information that was subject to the audit is free of material misstatements. Thus, an assurance engagement is one in which the professional accountant, which is the auditor in this case, expresses a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the outcome of the evaluation and measurement of a subject matter against the criteria. So here, as we said, we are giving an opinion. We are reporting to the shareholders about an opinion. That means giving the shareholders an assurance of that the information that is presented in their company is fair and true. This is an assurance engagement, and we've got two types of assurance engagements, which include reasonable assurance and limited assurance engagements. Now, reasonable assurance engagements is an actual audit. This is their kind of, opinion where we report to the shareholders by giving a conclusion or an opinion on what was our findings. And we also have limited assurance, which usually is a review, independent review that we do on a company. So whether a company is being audited or is going to get a review depend on the PI score, public interest score, and we're going to show you how the public interest score is arrived at. That will determine whether a company has to be audited or a company has to have a review, although a company can voluntarily require an audit. Reasonable assurance, as I said, is a high but not absolute level of assurance. Obviously, there is no way there will be an absolute level of assurance. There are always the audit inherent limitations that will not make it absolutely possible to have an absolute level of assurance. Only given when the auditor gathers sufficient appropriate evidence to be able to express an opinion on the fair presentation of the annual financial statements. It is expressed in a positive form by stating that, in our opinion, the financial statements were presented fairly. It is not as short as this, but that's how it began on a paragraph that shows our opinion after completing our audit. It's always given in an audit, which is reasonable assurance. Engagements will be given, reasonable assurance will be given in an audit. Now, limited assurance, this level of assurance is lower than reasonable assurance. The level of assurance given is lower as the extent of audit procedures, because that it is far less comprehensive than for an audit. So we're not too detailed there when you conduct the audit, because sometimes because of how small the firm is or how limited the internal controls and stuff like that. Expressed in a negative form, nothing came to our attention which causes us to believe that the financial statements do fairly present the obviously what's happening within the business. It is given in a review engagement, which we call an independent review. Okay. Now, there are some limitations to an audit, which we call inherent limitations of an audit, which comes because of the nature of financial accounting. In general, accounting includes a lot of judgments, assumptions, and estimations, which may make it quite maybe difficult to really have an absolute audit assurance opinion that we can give. Now, we also have the nature of audit procedures that can be taken, which means practical limitations to the nature of audit procedures that an auditor can use to arrive at an opinion. Evidence is usually persuasive rather than conclusive. The use of testing in audit engagements, there's a lot of test of controls, test of details to arrive at an opinion. And because of the detail of those testings, it might act as a limitation as well. Inherent limitations of accounting and internal control systems. So it would depend with the client's internal control systems and internal controls that they've put in place in general, as in whether those are effective to warrant an actual fair presentation of financial statements. Timeliness of financial reporting and balance between benefit and cost. So at the end of the day, an audit is a costly process, and sometimes the budget will not make it possible to go into serious detail when arriving at an opinion. So the auditors may end up using what it is at their disposal at the in accordance with the cost that is there or the budget that is there for such an audit. Other matters as well that may cause a limitation. Now, non-assurance engagements. In these kind of assurance, we are not expressing an opinion or a conclusion. So these are not assurance engagements, do not meet the definition or contain the elements of an assurance engagement. The main characteristic of an assurance engagement is that no opinion or comment is given by the auditor in his or her report. They include what we call agreed upon procedure engagements or compilation engagements. We talk about them. So in agreed upon procedures, this is certain or specific areas that we have agreed that the auditor needs to do their work, usually by following sort of audit procedures, but we are not seeking for an opinion or a comment. We just need to find a report of the key findings in that area. The objective of an agreed upon procedures engagement is for the auditor to carry out procedures of an audit nature to which the auditor and the entity and any appropriate third parties have agreed and to report on factual findings. Now, we've got compilation engagements, which deals with the practitioner's responsibility when engaged to assist management with the preparation and presentation of historical financial information without obtaining an assurance on that information. Management retains responsibility for the financial information and the basis on which it is prepared and presented. So this is kind of engagement in which the auditor is being appointed to prepare the financial statement of a company and not to give a comment or an opinion. Is only compiling all the information and put together a set of financial statements. Now, we talked about how an audit, how a company can be decided or can decide that it is going to have an audit. So we have a mandatory requirement in which a company is to be, we have to decide that this company is going to be audited. So we usually use what we call the public interest score, which is calculated. So for example, in South Africa, you calculate whether a company is supposed to be audited or not by using this. You're going to look at the number of points, equal to every average number of employees So in a year, obviously, we're going to say what we started with, the number of employees at the end of the year, the number of employees that we had. We take the average, add them, divided by 2. So let's say at the end of the year, we had an average of 50 employees. So that's 50 points. And then every 1 million of revenue, after calculating the financial statements, obviously. So if you've got 100 million of revenue, then it means 100 points. So you add on the 50, and then 1 point for every 1 million third-party liabilities. So you've got loans, debentures, and stuff like that. Those are loans. If they amount to 30 million, that means 30 points, and the 1 point for every individual who directly or indirectly has a beneficial interest in any of the company's shares. So if, I mean, we're talking about shareholders, if a company has 100 shareholders, that's 100 points. So you add all those four, and if the PI score, or if the score that you get there is above 350, that company is required, I mean, it's 350 and above, that company is required mandatorily, it's mandatorily required to be audited. And if the PI score is between 100 and 349, as well as the financial statements were internally compiled, means by somebody who is an employee of the company, then this company has to be audited as well, because there is no independence in compiling the financial statement. It was compiled within the company. So it will be much more riskier. We need to audit it. And then if it is 100 to 349, but the financial statements were compiled by an independent practitioner or accountant, then the risk of misstatement is low, and we can do an independent review there. But for others that are below 100, that's an independent review straight away. There's no need for audit. Although a company can voluntarily require an audit, which is allowed in South Africa. This should be the same. This is the same in your country, or countries that you are based. There is a PI, public interest score, which is more or less similar to this, but this is how it is calculated. Now, in auditing, we have got what you call auditing postulates, which are usually basic assumptions and logical principles and requirements which serve the auditors in forming their opinion. So these are just like general things that auditors do in coming to have a final conclusion or opinion on the financial statement that they are auditing. So a postulate is a foundation on which a discipline is built, and there are certain underlying principles or postulates which serve as the basis of auditing theory. Now, the postulates provide guidance on the auditor, or for the auditor, that helps to determine the extent of audit procedures that should be applied in the audit. So we've got about 8 of these that we're going to discuss. One, there is that no necessary conflict of interest exists between the auditor and management or employees of the enterprise. So that's a requirement. They should be independent on the part of the auditor. So there's no conflict of interest, there's no self-review, there's no advocacy, there's no or any of those. And then we can say the auditor can independently do their work. 2, an auditor must act exclusively as the auditor in order to be able to offer an independent and objective opinion on the fair presentation of financial statement. Same as number 1, independence here. And then the professional status of the independent auditor imposes commensurate professional obligations. So most of the times they are qualified members of chartered accounting bodies or other bodies. So their professional status, of course, matters. And then we also assume that financial data is verifiable, because we can have audit trail, and we can verify any financial data. And then we also have internal controls reduce the probability of errors and irregularities. So if a company has internal controls, at least that give you a sense of that their errors should be limited. And if the internal controls are much more effective, then that would be much more better as well. Application of generally accepted accounting practices results in fair presentation. So if a company is using, for example, the National Financial Reporting Standards, when they are preparing their financial statements, that will warrant fair presentation and to give us at least that confidence that the financial statements are presented fairly. So there are different accounting practices around the world. In the US, we talk about generally accepted accounting practices, and then others follow IFRS in most cases, throughout the world, and that is it. So if a company is following along those general accounting accepted accounting practices, then their financial statements will be more likely to be fairly presented. And that which held true in the past will hold true in the future in the absence of any contrary evidence. So obviously you're going to look at the previous financial statements and it will give you a clue as in what's happening within the company. And usually things that have been identified in the past can give you also the guidance what needs to be done and how to carry the audit for the company. The financial statements submitted to the auditor for verification are free of collusive and other unusual irregularities. So obviously this is an assumption that will be made that obviously if a company has given you financial statements that you are going to base your audit on, the assumption is that those financial statements are free of collusive and other unusual irregularities. Although we're going to talk about the professional judgment and professional skepticism that the auditor has to perform or has to have when they are doing their work. Although this is the assumption generally, but the auditors are there to identify areas of weakness, identify fraud, identify a lot of other stuff. So the financial statement audit engagement. So this is specific to financial statement, and that's what auditors are normally doing. So what is the auditor's responsibility with regard to the financial statement audit engagement? So international standards for auditing 200 paragraph, section 200 paragraph 7 requires the auditor to exercise professional judgment and maintain professional skepticism throughout the planning and performance of the audit, and among other things also the following. They have to identify and assess risks of material misstatement, obviously by performing, by looking at sessions at account balances, sessions at financial statement level. They have to obtain sufficient appropriate audit evidence that will help them to form an opinion on the financial statements. Now, overall objectives of the auditor. The first objective of the auditor is to obtain a reasonable assurance, obviously to express an opinion whether the financial statements are free from material misstatement, whether due to fraud or error, thereby enabling the auditor to express an opinion on whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework like GAAP, like IFRS. Now, to report on financial statements and communicate as required by the international standards for auditing in accordance with the auditor's findings. So after getting an opinion, obviously they will report to the shareholders and obviously to the board about what they've found. And sometimes it also include management report or an audit report, audit report that includes a recommendation on what needs to be done, what changes to be done, and what internal controls should be improved. Now, when it comes to auditing, there are various parties that are involved. As we have been mentioning, the roles of these various parties are important. We've got shareholders who usually provide the financing, and appoint directors and appoint auditors, and will ultimately receive the annual financial statements as part of the stakeholders. We've got directors responsible for running the company and reporting results to the shareholders. Also prepare the financial statements in terms of an appropriate financial reporting framework. So this is important because directors, although they appoint a professional accountant or an auditor to prepare their financial statements. They are still the ones that are responsible for the preparation of those financial statements according to a framework that is required. Then we've got the auditors responsible for gathering, auditing evidence to give an opinion on whether the annual financial statements prepared by the directors to the shareholders fairly present the financial position and the results of the company. So these are the roles of the various parties of these parties that we identified. Now, management assertions regarding the financial statements. So management are responsible for the fair presentation of the financial statements. Management makes the representations about the company's assets, equity, liabilities, and transactions and events. So these representations are termed assertions of management. So here we're just saying management, the board and everything is responsible for the financial statements that they will present for auditing and that they are fairly presented. And the management also makes representations about the company's assets. So in those financial statements, they're talking about the assets, the equity, the liabilities, and transactions and events that have happened throughout the year or the financial year. So those are what we call sessions of management. So that's where the auditor is going to focus. The auditor is going to focus on their audit. So management assertions regarding the financial statements, there are two categories of assertions, namely assertions about classes of transactions and events and the related disclosures for the period, and then assertions about account balances and related disclosures for the period. When asked to list and explain, for the sake of the small test that you may be required to take, you should remember to link the assertion to the particular account that is asked. And also, when we ask a question about management assertions on either classes of transactions and events or account balances, we expect you to give all the relevant assertions. So we're going to talk about these assertions now. So assertions about transactions and disclosures. So whenever an auditor is carrying their work, they are looking at transactions that have happened throughout the year. For example, it can be an expense, it can be an amount that is capitalized to an asset, but we want to check its occurrence, completeness, accuracy, cutoff, and whether it was correctly recorded during the financial year. So we're going to talk about occurrence. That means a transaction or event which has been recorded in the books actually took place and pertains to the entity. So whatever has been recorded, we want to be assured that it has actually taken place, maybe by showing transfers from the bank and all those things, and whether it is something that pertains to the entity and its operations. Completeness, all transactions or events which should have been recorded have been recorded. So everything that should have been recorded, we want to make sure that it has been recorded. Then accuracy, amounts and other data relating to recorded transactions or events have been correctly and recorded appropriately. They've been recorded appropriately. So what has been recorded, we want to be sure that it has been recorded appropriately. Maybe whether the estimates are correct, or whether the judgments that have been applied are correct. Then cutoff, transactions or events have been recorded in the correct accounting period. And then classification, transactions or events have been recorded in the proper accounts. Definitely. And then presentation, transactions or events have been appropriately aggregated or disaggregated and clearly described, and related disclosures are relevant and understandable. So we want to make sure that all your disclosures are there and they are pertaining to what has transpired. Now, assertions about account balances and the related disclosures. These are usually balances that appear on the on the on the balance sheet, or what we call statement of financial position. So we want to see whether there is an existence. So we want to see whether assets, liabilities, and the equity interests that have been shown in the financial statements actually exist. Then completeness, we want to show that we make sure that all assets, liabilities, and equity interests which should have been recorded have been recorded. And rights and obligations, the entity actually holds control or owns the rights to assets, and then liabilities are the obligations of the entity. So are these liabilities actually the obligations of the entity? Then accurate valuation and allocation. Assets, liabilities, and equity interests are included in the financial statements at appropriate amounts, and any resulting valuation or allocation adjustments are appropriately recorded. Then in classification, assets, liabilities, and equity have been recorded in the proper accounts. It is important. Then presentation, assets, liabilities, and equity interest have been appropriately aggregated or disaggregated and clearly described, and related disclosures are relevant and understandable. We're going to move to topic 2, which will talk about regulation of the auditor. Regulation of the auditor. So most countries have acts that regulate the auditors, like we talked about the auditing profession, and various other acts where regulation of the auditors comes from. For example, Companies Act. We have a code of corporate governance that are there, like Sarbanes-Oxley, like in South Africa, King 3, and various ethical codes that are there for various accounting bodies. Quality control of audit work, calculate control procedures that are there. The regulation of auditors is necessary to ensure that auditors behave ethically and professionally in the conduct of an audit. So it is important to regulate their behavior, their work, and how they carry themselves. Okay. Now, because of the ethics that happens and everything, auditors, they have a duty to report on irregularities that they see when carrying out their duties. Example, if it is clear that when they are carrying their duties, they have seen that there is serious irregularity that is happening, maybe with with management or a director of a company, maybe stealing, they have to report that irregularity to their regulatory body. For example, in South Africa, it will be South African Institute of Chartered Accountants, or ERBA, which is the auditor's regulatory body here. So a reportable irregularity means an unlawful act or omission committed by any person responsible for the management of an entity, which has caused or likely to cause financial loss, or is fraudulent, or amounts to theft, or represents a material breach of a fiduciary duty. So management has a fiduciary duty, or the board has a fiduciary duty to act in all material respects for the benefit of the shareholders. So if an act is fraudulent or amounts to theft or represents a material breach of a fiduciary duty, that is an irregularity, and the auditor is required to report it to their regulatory body, and then investigations can carry out. We also have ethical principles regulating the profession. The ethical principles governing the conduct of auditors belonging to the profession are summarized in 3 principal sources, namely the International Federation of Accountants Code of Professional Conduct. That means for all professional accountants. This one is world over, so it governs all other professional, regulatory bodies in various countries. So various countries usually have taken the Code of Professional Conduct and adopt it in its entirety, and use them and structure it obviously to suit their countries. Regulatory bodies for auditors, which means, as we are talking about, for registered auditors, just like the South African Institute of Chartered Accountants, SICAM. It can be the Institute of Chartered Accountants of England and Wales, and it can be also various other auditing bodies. that are there that are regulating the conduct of auditors. Various acts regulating auditors means per country. For example, I stated that in South Africa we have got the Auditing Profession Act. That it should be there also in your country, and you just have to look at which acts that are there in your country that governs the conduct of auditors. Okay, so ethical principles regulating the profession. We've got ethical principles, as we stated earlier. We're going to expand them, but these are the principles we talked about: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. We also have threats to ethics. So you have to be ethical, you have to have integrity, objectivity, professional competence, but there are threats that can give you a hint, as in you are going off with one of these principles. For example, there's what you call the self-review threat. This one is where an auditor will end up reviewing the work that they have performed themselves. For example, an auditor has been asked to compile financial statements for a company, and then after compiling them, the auditor is also required to audit those financial statements. So they are auditing their work, which we call a self-review threat. So there should be serious consideration, as in whether the ethics here, the integrity, objectivity principles are not being breached. They've got self-interest, which we talk about conflict of interest, where you're going to audit a company that you have interest, or their financial interest, or their shareholding interest, and other things that may cloud your judgment and your independence. You've got familiarity, where you know maybe the management of the company that you're going to audit, and your opinion definitely is going to be biased because of your association with the management or some influential people of that company. Now you've got intimidation, in which by other means you are being intimidated to give a proper conclusion because of some things that may be information or pictures or things that they're holding against you. And then you've got advocacy. So these are the threats that are there, and they can really affect ethical principles that we listed up there. Now there are various safeguards to reduce these threats. Like, for example, safeguards through regulation. I mean, regulation has been put into place through the regulatory bodies that governs the work of auditors, that at least reduces these kind of things. And then we've got legislation like the Audit Profession Act, which will obviously work as a hindrance. In other countries, they've actually legalized it. I mean, and it can actually cause. In South Africa, it is mostly principle based, but in other countries, it is actually compliance based, which means if you don't comply, you will be sued and you go to jail. I think in the United States it is compliance based, and if you don't follow the legislations and the requirements, it's grounds for cases and stuff. And then the profession, we also have safeguards in the work environment, which the companies can put through internal controls to reduce these threats to ethical principles. Now, we also have quality control for audit work. So audit firms are required to implement policies and procedures to monitor the firm's practices and to ensure that the internal standards of auditing are being followed. So internal standards on quality control requires that the auditing firm to establish policies and procedures designed to improve it, to provide with the reasonable assurance that the firm and its personnel comply with the relevant ethical requirements. So this is a requirement that any firm has to put in place. ISA 220, International Standards for Auditing 220 deals with the specific responsibilities of the engagement partner regarding quality control procedures for an auditing of financial statements. So quality control is a requirement for an auditing firm and for auditors to abide with. So we can see that ISQC 1 established an auditing firm's responsibility for its system of quality control. We want to see what they put in place in terms to make sure that their audit deliverance is of quality. Then the National Standard for Auditing 220 provides guidance on engagement teams' responsibilities regarding quality control for audit engagement. So the teams that are going to do the audit, there are requirements that they have to abide to make sure that their engagements are of a standard quality. Okay. So auditing firms' system of quality control. The requirement of quality control applies to all firms in respect of audits and reviews of financial statements. The auditing firm shall comply with each requirement of the ISQC and unless the requirement is not relevant to the service provided. So elements of a quality control system. What constitutes a quality control system that will give rise to a quality assurance or quality auditing procedure? So leadership responsibilities for quality in the firm. So first of all, the audit firm leadership should be responsible for the quality in the firm. Then they are also following relevant ethical requirements or principles, acceptance and continuance of client relationships and specific requirements. So during planning, they have to decide whether to accept or continue with a client by looking at various issues that can affect independence, controls, and stuff like that. Then human resources, engagement, performance, and monitoring. Quality control for an audit of financial statements. The engagement partner is responsible for the overall quality on each audit engagement to which that partner is assigned. So the quality on the audit is a responsibility of the audit partner, obviously with his team. Now we're moving on to topic 3, which we call general principles of assurance engagements. This is quite more important. We're going to talk about assurance engagements, the internal controls that can be put in place, kind of audit evidence that we have, risk assessment and audit procedures. So how do we assess the risk before taking an audit and during the audit, and then the procedures that can be taken to come out with an opinion. We'll talk about materiality, audit risk, audit documentation that you have to take or to put in place as a basis for your opinion, and then assurance reports. So assurance engagements, we have spoken and we have introduced and talked about what is an assurance engagement. So overall objectives of the auditor, as we spoke earlier, is to obtain a reasonable assurance on whether the financial statements as a whole are free from material misstatement, and to report on the financial statements and communicate as required by ISA. So we have talked about this. We have 5 requirements that the auditor has to abide by. Obviously, ethical requirements. Remember the 5 principles, ethical principles of integrity, objectivity, performance, professional competence and due care, confidentiality, and professional behavior. And then we have got professional skepticism. As we stated earlier, that the auditor has to practice professional skepticism. They have to be skeptical or thinking of what could have been wrong, maybe in this calculation or in this treatment of assets, of financial instruments, of liabilities, and other stuff. So it is very important that an auditor remains skeptical throughout the planning and throughout the auditing. We also have professional judgment, where the auditor has to always use his professional judgment when carrying out his work. The auditor shall exercise professional judgment in planning and performing an audit of financial statement. So there's a lot of judgment, as in to come to conclusion, or as in what's on the ground, that the auditor has to be up to task to do those judgments and to understand the assumptions that the financial the preparers would have used. Okay, then sufficient appropriate audit evidence on the audit risk. The auditor has to obtain reasonable assurance. So the auditor shall obtain sufficient and appropriate audit evidence to reduce audit risk to an acceptable or an appropriate level, and thereby enable the auditor to draw reasonable conclusions on which to base the auditor's opinion. So it is important that auditors get sufficient evidence for him to come to a conclusion about whether the financial statements are fairly presented or fairly prepared. And then the last one, conduct of an audit in accordance with international standards for auditing. The auditor shall comply with all international standards for auditing relevant to the audit. So all international standards that are required for an audit. And international standard for audit is relevant to an audit when the ISA is in effect and the circumstances addressed by the ISA exist. What is the ISAs? The ISAs contain objectives, requirements, and application and other explanatory materials that are designed to support the auditor in obtaining reasonable assurance, as we have stated earlier. Okay, now, in doing an audit, internal controls are very important. And the auditor is going to first omit these things whenever they are looking at the control environment of a company that they're going to audit. They're going to assess the internal controls in that company and to determine whether they are of sound or effective, and they carry out tests of controls to see whether they're performing effectively. So ISA 315 defines internal control as the process designed, maintained, designed obviously by those charged with governance, and they're supposed to be there to show, to be effective or to reduce errors, fraud, and stuff like that. So and other personnel to provide reasonable assurance about the achievement of an objective with regard to the reliability of the financial reporting, the effectiveness and efficiency of its operations, its compliance with applicable laws and regulations. So internal controls, obviously, after if the internal controls are effective, they will make sure that our financial statements are reliable, or we can place our reliance on the financial statements that have been presented, because all our internal controls are working perfectly. And then the effectiveness and efficiency of its operations, it will be highlighted by the internal controls that are in place, and then the compliance with applicable laws and regulations. Now, who is responsible for internal controls in the business? We want to know that question. Everyone is. This includes the board of directors. So this should be a tone that is put from the top to the bottom of the company. So including directors, management, and employees. The board has overall responsibility, obviously, and accountability of what's happening within the business and the internal controls within the business. Management identify risks, design and implement policies and procedures to address these risks. Employees execute internal control procedures. So everyone is really responsible, but the ultimate responsibility lies with the board. Thus, the success of internal controls depends on all parties involved. Now, internal controls definitely are not 100% foolproof, because they are put in place by humans, and there will be always some bit of overrides that can happen, but at least they can have a level of assurance that they can foolproof errors or fraud and stuff like that. So do they have 100% foolproof? No, as no single control can neatly address each identified risk. Thus, as internal controls can be fallible, they work best in combination. So there's an example here where a student card is required to enter, for example, a university library. The security guard at the entrance gate should inspect the photo on the student card to confirm that the person entering the library is indeed the authorized user for that card. This is an example of a control that can be set in place. Or when an employee is getting into the company to come to work, they may go through, they may have to clock, and we know that they are available and stuff like that. Those are examples of internal controls. Not that there are two controls in place before you can enter the library. So one, presenting your student card; two, inspection of the student card by the security guard. So because internal controls cannot be 100% foolproof, it is because, for example, a security guard can actually override these rules and allow a student to get in because they can override that rule. So that's why internal controls cannot be 100% foolproof, because there's always the human element. What are the key characteristics of internal controls? It is that it is a process, it is effected by people, not the sole responsibility of management, so everybody. It is not static. It means they might need to change all the time and improve our controls. It is not foolproof, as we stated. It is not a case of a single control addressing a single risk. So that's the reason. Does internal control have limitations? Yes, internal controls does not provide absolute assurance that the risks that threaten the achievement of the objectives of the business will be adequately responded to. This is due to the inherent limitations of internal controls. So, what are the inherent limitations of internal controls? So, first of all, cost of internal controls does not exceed the expected benefits. Tendency to be directed at routine transactions, or they are usually routine. They are repetitive in nature. There is potential for human error, possibility of circumvention of internal controls through collusion. So, for example, two people who are responsible for two different duties can collude to override and get access to maybe assets of the company. Management overriding and internal control. So it can be management actually who are supposed to be authorizing and everything, and then they override, and for different purposes that can be fraud, that can be in other reasons. Changes in conditions resulting in internal controls becoming inadequate. So those are the limitations that are there with internal controls. Now, what are the components of internal control? There are 5 components of internal controls, which include the control environment. The control environment usually sets the tone of the entity and creates the atmosphere in which employees go about their duties. The desirable mindset is one of doing things the right way. So organizations or the management are the ones who can create this tone or set this tone of how they want their organization to operate. 2, risk assessment. In South Africa, we have got what we call the King 3, which is a corporate governance code that is here, more or less like the Sarbanes-Oxley thing in the UK. So this code here states that the board should ensure that risk assessments are performed on a continual basis. Risk assessment is important because internal controls are designed and implemented as a response to assess the risk. So obviously they start by assessing risk through various means, risk assessment, risk registers and stuff, and we've identified the risks that are there, and then we put in place internal controls to mitigate those risks. It is therefore critical that the risk assessment process is comprehensive, accurate, and thorough, and complete. Now, the third one is information system. Obviously, there should be an information system within the company. The objective of the information system and its subpart, the accounting system, is to produce information that is valid, accurate, and complete, and timelessly produced. And then fourth, the control activities. So these are the activities that are put in place, obviously in the internal controls, to make sure that we reduce or manage the risks, and also to make sure that we achieve our objectives. Control activities include approval, authorization of things, segregation of duties, isolation of responsibilities, obviously to avoid collusion, access, granting access and custody, comparison and reconciliations to verify and to check accuracy, performance reviews, and so forth. Control activities can be preventive, detective, or corrective in nature. And then the last one, which is monitoring of controls. The monitoring of controls involves the assessment of internal control performance. So we have set out our controls, and then we are monitoring them to see if they are delivering the results that we want. If controls are not monitored, the board or management will not know if the entity's financial reporting is reliable and whether the laws, regulations, and the common policies are being complied with. So that's why it is important. So we have talked about an accounting system, and an accounting system is a series or collection of tasks and records by means of which transactions are processed to create financial records. What are the major elements of an accounting system? So obviously the people who carry out the duties, writing out invoices, entering invoices into sales journal, processing journal entries, processing bank statements and all those. Two, paper such as order forms, ledgers, among other, which facilitates the initiation, execution, and recording of the transactions. Now, why must an independent external auditor obtain an understanding of a client system of internal control? So you are auditing a client, and then as an auditor, you need to understand the client's system of internal controls. One, an understanding of a client system of internal control assists the external auditor, obviously, to identify the types of potential misstatements and factors that affect the risks of material misstatement, and two, in designing the nature, timing, and extent of further audit process. So by looking at the client system of internal controls, you know, okay, which areas can be grounds for misstatements, fraud, and stuff like that, and then designing how you will audit those areas, and develop the audit procedures that you will carry. Then two, the external auditor is primarily interested in the fair presentation of the entity's annual financial statements. So the financial statements are a product of the information system, which includes the accounting system. So four, it tends to reason that the better the internal control procedures, the more likely it is that the financial statements will be fairly presented. So why is the audit evidence important? So after the internal control, the information system, the accounting system, and everything, why is the audit evidence important? Because this information or this evidence will have a direct impact on the opinion that the auditor will give on the financial statements. So are there any special characteristics that audit evidence should have? Yes. So they should have, the evidence should be sufficient and appropriate for the auditor to arrive at a conclusion. So sufficient audit evidence refers obviously to quantity as well as quality of the evidence that is there. We should remember we do not, in many instances, audit the entire population, but we usually take samples of what's there. For example, a sample of invoicing according to the materiality that the company have or that we have placed on the company. We will take samples of invoices, different categories and classes and balances, and then we will audit those. Therefore, we need enough evidence from our sample in order to draw reasonable conclusions about the population. So the size of the sample is influenced by the assessed risk of the account. So if the risk is high, we need to increase the number of samples that we audit. If the risk is low, which means the internal controls are effective, in those scenarios, we need to have a fewer sample of issues, of areas that we audit. Now, it needs to be relevant evidence. The evidence must be relevant to the assertions and that are being tested. Performing audits procedures to obtain evidence about the occurrence assertion. We will not provide you with audit evidence about the completeness assertion. It needs to be reliable. Obviously, the evidence needs to be reliable. Some evidence is more reliable than other evidence. So, in hierarchy of evidence, we have to look at, okay, whether it's coming from external or internal. Is it written or is it oral? Is it original or is it copies? And that will give you a look at as in how much more further procedures you can carry on the information and documentation that you've been provided with. So audit evidence in summary, it should be sufficient audit evidence and it should be appropriate audit evidence. And then under appropriate, it should be reliable, it should be relevant. So that's the thing. And then the next thing is risk assessment and audit procedures. So how do you go about obtaining the audit evidence that we are talking about? So by performing audit procedures. But what are the audit procedures? It is those actions performed by the auditor in order to obtain the audit evidence that we are talking about. So audit procedures consist of the risk assessment procedures. We need to assess the risk that is within the company, both at planning and at audit stages. Further audit procedures comprising test of controls and substantive procedures. So the National Standard of Auditing 500 provides us with the correct verb when obtaining audit evidence, correct verbs when obtaining audit evidence. So this includes inspection, by inspecting physically, observation, observing what's happening, maybe inputting invoices and everything, and coming out with the final things. It can be external confirmations or evidence. It can be recalculations. It can be re-performance. It can be analytical procedures that you are carrying or taking in order to come up with that evidence. It can be inquiry from various organizations that are maybe issuing invoices and stuff, and we want to inquire whether it has already actually happened. So these are some of the procedures that will be done in obtaining evidence. Now, risk assessment procedures are those procedures carried out by the auditor to gather information about the client so that the identification and assessment of risks of material misstatement at the financial statement and assertion level can take place. Risk assessment procedures consist of inquiry, analytical procedures, observation, inspection, discussion among engagement team to obtain an understanding of the entity and its environment. And then we have a test of controls by actually testing the controls that are in place within a company and see whether they are working perfectly. And this is by definition a procedure designed to evaluate the operating effectiveness of controls in preventing or detecting and correcting misstatement at the assertion level. So if, for example, if a wrong input is put in a system, an accounting system, we should detect that this is wrong and maybe provide also suggestions of what should be done to correct it. And then we can know that this system is working perfectly and is effective, and then we can rely on the financial information that it produces. So audit procedure, it is the actions obviously performed by the auditor in order to obtain audit evidence, as we spoke earlier. Operating effectiveness. So we're looking at the design. Does it prevent, detect, or correct misstatements? Through implementation, the control exists and the entity is using it. So we are looking at those things. And then material misstatement consists of either fraud or error. So when a misstatement has been identified, there are two things. Either it was an error that has happened and we are correcting it and we can track it and okay, how did it happen? Or it was fraud that was happening and we need to follow it and we need to detect it and follow the paper trail. Now, formulating test of controls. So that is discussed under ISA 500. How do you formulate a test of controls through inspection, reperformance, inquiry, and observation? And this is relevant. This is the relevant source of evidence and could comprise of documents, persons, and processes. The reason why you are considering the relevant source of evidence. So, for example, you observe a factory foreman inspecting the employee's identification before paying out the weekly wages to ensure wages are not paid to fictitious employees. So, using just a small example. Now, substantive procedures. Substantive procedures, this section obviously deals with the auditor's use of substantive procedures, which comprise of the tests of detail. So these are the further procedures that an auditor will do after risk assessment procedures and those. So we'll look at test of detail or analytical review procedures in order to obtain the audit evidence. It is performed to determine whether the amounts and disclosures in the financial statements are fairly stated. Now, an audit procedure designed to detect material misstatement at the session level, which is substantive procedures comprise of test of details as we explained. So, test of detail, we are testing the transactions and the balances. So transactions that have been happening through the year and the balances that we have at the end of the year. Then substantive analytical procedures, analyzing calculations and all those things to determine and get evidence. So ISA 315 defines the assertions as representations by management, explicit or otherwise embodied in the financial statements. Remember, we spoke about assertions earlier, and ISA 500 provides us with how to obtain audit evidence. So as I explained, you can do inspection of the records, documents, and assets, observation, looking at a process performed by others, so you can look as they are doing and they are performing a process, and then external confirmation. That means you can obtain evidence from third parties. Recalculations, mathematical accuracy of documents or records, reperformance, meaning calculation of depreciation and estimates and stuff like that to see if they are correct. Analytical procedures, evaluate financial information through analysis of plausible relationships. Then inquiry, knowledgeable persons within and outside the entity. So you can inquire from experts within the field, which can be inside or outside the entity. Those are some of the procedures that we do. Then formulating substantive procedures. So we said by inspection, reperformance, inquiry, and other things. And for an example would be inspect the bank statements to confirm receipts of the proceeds from insurance claim, for example. As you would have noticed, the formulation of both a substantive procedure and a test of control are the same. However, the objective of each procedure differ. Now, when you are to take a sample, first of all, there's something that determines or that gives you a direction of how you're going to take a sample. We call it a materiality, the materiality of the company. So you have to calculate a materiality figure. It is a concept used by auditors in determining whether the information contained in the annual financial report or financial statements is fairly presented or not. Thus, because the auditor can assume that the annual financial statements are not 100% correct, the auditor needs to decide on margin of error that is acceptable and thus not material to the fair presentation of the annual financial statement. So that materiality will give us, if something is more than that materiality, then we can say, okay, it is within the margin of error and we can ignore it, or we can just take corrective procedures to correct it. But if it's above this materiality, then we need to audit that in detail and see whether, what has been the cause, is there fraud, is there error, and stuff like that. So we focus more on where the materiality figure is higher than the materiality that we have calculated. So when is information considered to be material? Information is material if its omission or misstatement could influence the economic decisions of users taken on the basis of the financial statements. So if a figure that we found as being the basis for materiality, any figure that is above that, that has been omitted or miscalculated and stuff, means that the decisions that the users of the financial statements will make after using these financial statements with such an error will be different if that misstatement has been corrected, because it is too material. It will change maybe the outlook of the financial statements. So what is the nature of materiality? So it is subjective. The materiality figure set will be a matter of professional judgment. It is relative, that is, what is considered material will vary between audit clients. So depending on the amounts and planning and the industry that a client is involved in. Then it's quantitative and qualitative. Quantitative, omissions or misstatements exceed the amount determined by the auditor, so then we need to look further. Qualitative, regarded as material when judgment against a factor other than an amount. So that's how it is. Usually the materiality figure is calculated as above, as we see here. Quantitative, when you look at one, the turnover, so you can take at least 0.5% of the turnover, put it there. Gross profit, you put 1% or 2%, you can choose there, you put it there. Then profit before tax, 5% to 10%, put it there. Then total assets, the total value of it, you calculate 1% to 2% of it, and you add the total of those. That will be your materiality figure. It also can include control environment and effectiveness of internal controls, integrity and management, irregularity. So we can also create a figure according to the assessment, and then we add the total that will give us our materiality. And any figure that is above that, we need to audit it a bit deeper, and figure that is below that can be ignorable, and we can say it does not affect much. When is the concept of materiality applied by the auditor? So obviously during planning, audit, and during the performance of the audit, to evaluate the effect of identified misstatements on the audit and of uncorrected misstatements on the financial statements, and then forming and expressing an opinion in the auditor's reports. So what is the difference between materiality and performance materiality? So when you are auditing the financial statements, I mean the financial position and the financial performance at the profit and loss and balance sheet, actually, what you use as your basis for selecting your sample is the performance materiality. So materiality is the actual figure in whole, including the qualitative and quantitative considerations. The auditor first determines materiality for the financial statement as a whole. Then performance materiality is used for purpose of assessing risks of material misstatement and determining the nature, timing, and extent of further audit procedures. So thus, if the audit risk is assessed as high, materiality and thus performance materiality must be low. Bigger sample sizes, accept less errors, etc., and vice versa. So usually the performance materiality is around 85% of the actual materiality. So usually that's the figure that, for example, in South Africa we usually use, and is considered appropriate. Now we look at the audit risk. So what is the audit risk? This is the risk that the auditor will express an inappropriate opinion. So the auditor will express an inappropriate opinion when the financial statements are materially stated. So the auditor may say the financial statements are fairly represented, whilst in fact they are materially misstated, and That's the risk that we talk about. Can audit risk be completely eliminated? So it's not possible to eliminate this risk, as there are inherent limitations to an audit. Remember, we spoke about them earlier. These limitations are the nature of financial reporting is itself has got a lot of judgments, assumptions, estimations, and stuff. The nature of audit procedures that include samples, incomplete information that you are given sometimes, and then time constraints, that means quality of evidence, because we are trying to rush or to complete according to time frames. And then the cost or benefit, because there's a budget and we cannot afford to surpass that budget. So those are the inherent limitations that will affect the audit. So what are the components of an audit risk? So audit risk is actually made of 3 risks, which we call the inherent risk. We have the control risk and the detection risk. So the first 2 are risk usually at the audit client or at the company you are auditing, because they are there. It can be internal controls, stuff like that. So risk of material misstatement is there. And then the other one is the auditor's risk, the detection, whether he is going to detect maybe misstatements or not. So there is an inverse relationship between detection risk and the combined level of inherent and control risk. When inherent and control risk is high, detection risk must be low in order to reduce the audit risk to an acceptable level, and vice versa. So inherent risk is the susceptible of an assertion about a class of transaction, account balance, or disclosure to a misstatement that could be material, either individually or when aggregated with other misstatements before consideration of any related controls. And we also have control risk, the risk that a misstatement could occur in an assertion about a class of transaction, account balance, or disclosure that could be material, individually or when aggregated with other misstatements, will not be prevented or detected and corrected on a timely basis by the entity's internal control. So we just audit that this misstatement will not be detected by the company's internal controls. Then detection risk, that the procedures performed by the auditor to reduce the audit risk to an acceptable low level will not detect a misstatement that exists and that could be material, individually or when aggregated with other misstatements. So in simple terms, we're saying if the control risk is high, that means we're going to perform a lot of control, test of controls and all those things, because we're thinking that the internal controls are not really detecting things. So there will be a lot of symbols to test. That means we will be able to detect a lot in there. So we base that our detection risk should be a bit higher as well. So that's how it is in simple terms. So what you're trying to say, and then that will have an effect obviously on the overall audit risk. And then what is the objective with audit documentation? So in carrying out the auditing, the auditors would need to have appropriate documentation that they gather and some that they create in order to substantiate their opinion or to support their final opinion that they give you on the financial statements. So the objective of the auditor is to prepare documentation that provides a sufficient and appropriate record of the basis for the auditor's report and the evidence that the audit was planned and performed in accordance with the national standard of auditing and applicable legal and regulatory requirements. So audit documentation means documentation for audit work includes working papers, drawn up in relation to the conduct of the audit. These working papers should be sufficiently complete and detailed to provide an overall picture of the audit, which will ultimately enable the auditor to express an opinion in the report. So, in terms of the overall objectives of the auditor, in terms of the national side of auditing, the overall objectives of the auditor, as we explained several times, that it is to obtain a reasonable assurance and to report. So we're going to thus, at the conclusion of the audit, the auditor should provide a written report stating the conclusions or opinions that he has reached based on the assurance evidence that he has obtained on the relevant audit that he has been carrying. The audit report should include management responsibility for the annual financial statements. This is just a section where management obviously is taking responsibility for the preparation of financial statements, and that they've been prepared according to a known framework. And then we have the auditor's responsibility, talking about what was the auditor's responsibility, what they did, and stuff like that. And then the auditor's opinion, as in what was their finding in terms of the audit that they have done. So usually that's where they state, in our opinion, the financial statements were presented in all material respect fairly, and represents what has been happening in the company. Or it can be an adverse opinion, or it can be modified opinion. So there are different types of opinions that can be given, and we will talk about them later. Now, the audit process. So the audit process, which we have been talking about what is happening, what is an audit and everything. But this is usually a process. So it starts with the preliminary engagement stage, where we first of all meet the client, ask around about what's happening in their business, the industry, and then we also look about what is usually happening in those kind of industry, and then we go to planning stage. Planning to look at the industry that the company is in, and then talking with the management and stuff like that, and then we plan our audit as well, according to the industry and according to the financial statements that are presented to us. And then 3, evaluating, concluding, and reporting. Well, that means we do our evaluations, we conclude as in our findings, and then we report. 4, the evaluating, concluding, and reporting stage. Okay, so it is more or less the same, and is the third point. So preliminary engagement stage. So preconditions for an audit. So we're talking about what happens before an audit, during the planning, during the auditing, and then at concluding, or in overall. It's the same that we've been talking about, and now we're just looking at the overall picture is what happens from the beginning to the end. Preconditions are that financial reporting framework to be audited is acceptable, so it's either GAAP, it is either IFRS. The auditor obtains agreement with management acknowledging their responsibility. So managers have to accept that they are responsible for preparation of the financial statements, implementing internal controls, and providing the auditor with access to all information. And then accept or continue an audit only when established, we have established that whether preconditions are present, and then we confirm common understanding of terms of audit engagement. So auditor, management, etc. Now, prospect clients or continuance within existing client. Audit firm to decide if it wishes to establish new or continue with an existing relationship with the prospective client. The audit firm, being a business, will not enter into the relationship if negative consequences are to follow, such as client management appears unethical or lacking integrity, or not wanting to be associated with an industry, or client does not pay the audit fee. It has a history of paying the audit fee, not paying audit fee, or sometimes you just don't want to audit a specific industry because of maybe various regulations, and that can delay the audit. The acceptance decision will be easier for an existing client as the auditor has a history with them. So it's easy to accept. Compliance with standards. So in the National Standards of Auditing 220 require the audit engagement partner to be satisfied that appropriate procedures regarding acceptance or continuation of client relationships have been followed, and conclusions drawn are appropriate. The engagement partner must consider the integrity of the client, consider if the audit firm is competent to perform the engagement, if the firm can comply with ethical requirements. So procedures to gather preliminary engagement information. It is vital for an auditor to gain an adequate knowledge of the client business, because this will assist the auditor to identify and evaluate events that may adversely affect their ability to plan and perform the audit engagement. So we need to communicate with the previous auditor to see or to gain an understanding of the auditor, of the company, discuss with the client's directors, or those charged with the governance, inquiry of the firm's bankers, legal counsel, etc., background searches of relevant databases, a review of any documentation, inquiry of firm's independence in relation to the client. Now, establishing an understanding of the terms of the engagement. When an auditor accepts an audit engagement from a client, a contractual relationship arises. The contractual relationship is formalized in the engagement letter when the two parties sign the letter. The engagement letter also helps to avoid any misunderstandings in the audit. So there is an engagement letter, which is a document that describes the terms and conditions of this audit. It should be an agreement. It's like an agreement between the auditor and the client. Now, planning an audit involves establishing the overall audit strategy for the engagement and developing an audit plan. The objective of audit planning by the auditor is to ensure that the audit will be performed in an effective manner. So identifying and assessing the risk of material misstatement. Once an auditor has issued an engagement letter to a client, the auditor can then start to gain an understanding of the entity and its environment, including the internal control. See the slides on risk. We talked about it earlier, so you can just refer back to see that. Planning. The objective of audit planning: to plan the audit so that it will be performed in an effective manner. Obviously, that's the objective of having an audit planning or having an audit plan. Advantages of proper planning: that should include attention will be devoted to important areas, and then potential problems are identified and solved on a timely basis. So it's better to have a plan done in audit planning, because it will reduce your time spent on other areas, because you have already planned about that outcome. The audit plan. The audit plan is more detailed than the audit strategy. Many of the factors which include the audit strategy will also influence the audit strategy will also influence the audit plan. The audit plan shall include the following: the nature, timing, and extent of planned risk assessment. So remember the risk assessment that we talk about, we need to look at the nature of it, timing, and how long. Obviously, how long it's going to take. The nature, timing, and extent of planned further audit procedures. Other planned audit procedures to satisfy the ISA requirements. So then audit documentation. The auditor should include the following in the audit documentation: the overall audit strategy, the audit plan, any significant changes made to the audit strategy or plan, including the reasons. So changes to the overall strategy and audit plan. The auditor may need to modify the overall audit strategy and audit plan due to unexpected events, Changes in conditions or the audit evidence obtained from the results of audit procedures, thereby resulting in the planned nature, timing, and extent of further audit procedures based on the revised consideration of assessed risks. So the auditor's responsible to risks at the financial statement level and at the so this is the auditor's responsibility to risk at the financial statement level and at the accession level. So in previous topics, we learned that the auditors responds to the assessed risk of material misstatement by conducting further audit procedures. So if there are any other material misstatements, we have to test more controls, substantive procedures, and to do more tests. The auditor responses will be at both the overall level and the accession level. It means the overall financial statements and then at each and every transaction and every account balance. So auditor need to design and implement overall responses to address risks of material misstatement at the financial statement level. General responses include assign more experienced staff on that issue, assign experts in corporate elements of unpredictability, and emphasizing importance of professional skepticism. So responses to assessed risks at accession level, auditor to design and perform further audit procedures based on the assessed risk of material misstatement at that accession level or at the accession level. Audit procedures, the audit must respond to the risks by ensuring that the nature, timing, and extent of tests of controls and substantive tests are correct to reduce audit risk to an acceptable level. Audit procedures carried out to satisfy the requirements of the international standards of auditing. The auditor obtains audit evidence by carrying out a number of audit procedures. For example, ISAT 570, which deals with going concern, requires some audit procedures to be performed, even if there are no risks regarding the going concern ability of the company. So these are some of the issues that need to be evaluated. So evaluation, concluding, and reporting. At this stage of the audit process, the achievement of the auditor's overall objectives in conducting an audit of the financial statements is evaluated. These objectives are to obtain, as we stated before, reasonable assurance and to report on the financial statements. So how do we evaluate? Evaluation of the audit findings. The auditor has to evaluate and conclude whether or not sufficient appropriate evidence has been obtained. Uncorrected misstatements are material, individually or in aggregate. The financial position, financial performance, and cash flows are fairly presented. All material events occurring after the financial year end and the date of the audit report have been identified and appropriately dealt with. Now, drawing conclusions on the audit results. The auditor must form an audit opinion, like we explained before, either a modified report, unmodified report, adverse reports, whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. In order to form the opinion, the auditor must conclude whether or not they obtained reasonable assurance that the financial statements as a whole are free from material misstatement, whether due to fraud or error. So an auditor's opinion can be an unmodified opinion. So an unmodified opinion will be expressed when the auditor concludes that the financial statements are prepared in all material respects in accordance with the applicable financial reporting. This is what other areas will call a clean report, but this is an unmodified opinion. Modified opinion, usually we are saying that there are some areas that we found that were not presented fairly, and maybe with correction they can be, and then we can recommend corrections. And then we've got an adverse opinion where things were adverse. We found irregularities, we found issues that gives worry. Now, audit report, know the elements that form the structure of the auditor's report. That means the title, address, introductory paragraph, etc. You should be able to write an unmodified auditor's report, or be able to explain all the elements of an unmodified auditor's report. So you can look at how auditor's report is structured. So that report should be dated no earlier than the date on which the auditor has obtained sufficient appropriate audit evidence on which to base his or her opinion. Before the auditor can sign the audit report, all the statements comprising the financial statements, including the relevant notes, must have been prepared, and those with the recognized authority must have accepted responsibility for the financial statements. The board. And then the last topic, engagements to review historical financial statements. So auditing principles relating to review engagements. So we talked about ethical requirements, skepticism, professional skepticism in engagement, level quality control. We talked about primary engagement activities, performing the engagement, determining materiality, obtaining an understanding of the entity, designing and performing procedures, subsequent events, written presentation, evaluating evidence obtained from the procedures performed, and then conclusion and reporting. So this is just more of a summary. So before accepting an assurance engagement, the practitioner or the auditor will carry out preliminary engagement activities as discussed below, determining whether the practitioner wishes to establish or continue a professional relationship with the prospective existing client, consider the integrity of the principal owners, the key management, and those charged with government, and determining whether the firm is competent to perform the engagement skills, by looking at the skills, the knowledge, and the resources that the audit firm has, determining whether the firm complies with the ethical requirements. Independence. So these are the things determine whether the financial reporting framework applied in the preparation of financial statements to be reviewed is acceptable, and obtain the agreement of management that acknowledges and understands the responsibilities. So these are some of the things that will need to be done. We'll look at the engagement letter, the intended use and distribution of the financial statements that should be described there, identification of the applicable financial reporting framework, the objective and scope of the review, the responsibilities of the auditor, the responsibilities of management, a statement that the engagement is not an audit, depending on the engagement letter that is happening. So that's what we talk about. We spoke about determining materiality, and then we also spoke about the control environment and understanding of the entity, which is important for determining further audit procedures and risk assessment that needs to be done for a client. So the process of obtaining an understanding of the entity in a review engagement enables the practitioner to, so this for a review, but it's the same for the auditor. So to plan and perform the engagement, appropriately identify areas where misstatements are likely to occur. So prepare appropriate responses to such areas identified. Evaluate responses to inquiries and results of analytical procedures, and so forth. So we have spoke about all these issues already. And then inquiries and analytical procedures. So we spoke about what are these and what do we do to obtain sufficient appropriate evidence as a basis for the conclusion. The financial statements, the registered auditor or the practitioner must design and perform inquiry and analytical procedures to address all material items in the financial statements, including disclosures, to focus on addressing areas in the financial statements where material misstatements are likely to arise. So those are the issues. When conducting these procedures, the practitioner remains alert to evidence which is inconsistent with other evidence, information that calls into question the reliability of documents and responses to inquiry, and conditions which may indicate fraud. So these are the things that needs to be taken into account. Essentially, the practitioner is required to conduct additional procedures if he becomes aware of any matter which causes the practitioner to believe that the financial statements may be materially misstated. So whenever there is any other information that comes to attention of the auditor, they need to more procedures that need to be performed. 3 specific matters in respect of which this practitioner must conduct procedures is related parties. This is a very important because there is a lot of fraud that can go on here, a lot of fraud that can go on here. And then fraud and non-compliance with the regulations and going concern. We need to determine whether the company is still able to continue as a going concern, or there is a risk of not being able to continue in the future. Then we talk about conclusion and reporting. That means forming the conclusion. We talked about evaluating whether the financial statements adequately refer to the financial reporting framework. That can be IFRS for SMEs. Consider whether the terminology used in the financial statements is appropriate, the financial statements adequately disclose the significant accounting policies selected and applied. The accounting policies are consistent with the framework and appropriately applied. Accounting estimates appear reasonable. The information presented in the financial statements appears relevant, reliable, comparable, and understandable. So, financial statements provide adequate disclosures to enable users to understand the effects of material transactions and events on the entity's financial position, financial performance, and cash flows. The overall representation, structure, and content of the financial statements complies with the relevant framework, whether the financial statements, including the notes, appear to represent underlying transactions and events in a manner which achieves fair presentation. Then we talked about expressing a conclusion, which can be an unmodified conclusion or a modified conclusion. Financial statements materially misstated. That's what we are talking about. And then modified conclusion, inability to obtain sufficient appropriate evidence. So sometimes we are limited on the evidence that we are given, and then we cannot express an opinion. That we can give a modified conclusion stating that we could not obtain sufficient appropriate evidence.